Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask you a thumbs up and subscribe. Questions, comments, put those below. Lots to talk about today. We got the Canadian national housing data. We got CPI inflation. We've got U.S. money, monetary growth. We got updates on the rental market in Canada, job losses, etc. I'm going to walk you guys all through that this week. But first and foremost, you can't start it off without talking about the national housing statistics. So again, every 15th of the month, we get the data dump from the Canadian Real Estate Association. The National House Price Index, or Home Price Index, I should call it, declined another 1.2% month over month. So prices continue to slide lower. The price decline is now 15% since peak in March. So the National Home Price Index is down 15% since peaking earlier this year. That's the steepest decline since the index was created in 2005. The last time we had a steep correction was in 08-09. The home price index dropped 9% peak to trough. So right now we're at 15%, and I think all indications suggest that there's more room to go. So this is already historically a pretty significant housing correction. The typical home has now shed about $132,000 off its price. Now, this is ultimately what the central banks want. The Bank of Canada needs house prices lower, and if they're going to tame inflation, right? If your house price drops by $132,000, that's less money for you to tap into through a refinance or a home equity line of credit to go and spend on a new car or to do a home renovation or to go on a vacation, right? We all know Canadians are fueling their lifestyle through basically the home ATM, as we call it, the bank machine. And so when that asset, the largest asset in most Canadians' balance sheet begins to decline, that there is that wealth effect, and there is going to be less spending in the economy, which is what, again, the central bank, I've never seen so excited, frothing at the mouth, begging, hoping for a recession in order to bring inflation down. So, but again, what we can see here, a couple interesting anecdotes, is that, again, while we do have a national housing market, real estate markets continue to be hyper local. The largest corrections we're seeing are obviously in the GTA, Vancouver, some of these highly levered housing markets that have seen really excessive growth over the last 5 years in particular. And then we look at some of these other markets. This is one RBC highlight. Calgary is actually up. Prices actually officially rising on a month over month basis. Again, personally, while I do invest there, I struggle to actually see that boots on the ground prices rising there. But again, it is at least outperforming other markets, which is ultimately part of my bull case when I started investing there over 3 years ago. It's a market that was so beaten down that it always depends on what you're doing there. Because I had somebody mentioned to me on Twitter, well, hey, Steve, that was a great Calgary call, but you missed the bigger macro picture, which is rates going up and that national house price is moving lower, and that's going to get hit as well. And while that may be true, it depends what you're trying to do. So for me personally, when I invest in Calgary, I'm buying long-term rental income streams. I have no intention to sell in the next year, 3 years, 5 years, 8 years. These are income streams for me that ultimately are going to fund my retirement. I don't have a pension like some public sector employees. This is an income stream that I'm picking up that I'm going to collect the rents 30 years from now. And so that's much different than, say, a lot of the Toronto investors that were piling into the Calgary pre-sale market with likely, I'm assuming, the expectations that they're going to flip these properties for a profit in 3 years. I think that's the wrong mentality, and I think that they're going to struggle to make any money there. That's my personal opinion. Obviously, we'll wait and see. But kind of understanding all this, so we know that national house prices are declining. We can now see some stabilization in the rental market as well. I've talked about this with you guys before, but rents typically follow the labor market. We know the labor market is starting to soften. We know that the job layoffs are picking up, obviously, as, again, house prices fall, demand collapses. We had some anecdotal layoffs just this week. First National, Manulife, Coast Capital here in BC starting to lay off some of their employees. Now, again, some of these banks were actually adding mortgage staff in March and April of this year. After the market had already peaked, they were still adding staff. So again, when home sales collapse, to decade lows in some of your major metros, it's no question that they're likely overstaffed, and we know that the mortgage market is certainly feeling the brunt of that pain. And all you have to do is really look at, if you want to get an indication of the demand for, mortgage sector employees and where house prices may or may not be going, all you have to do is look at the mortgage credit growth, which it continues to roll over and suggests that house prices still have room to go. So again, mortgage credit growth is your leading indicator for house prices. And this is one of the sort of indicators that I looked at, which caused me to turn bullish sort of during the late summer of the pandemic, despite the media and everybody freaking about these mortgage deferrals and what was happening. It was like you could see that mortgage credit growth was accelerating, that this was going to be, it was hard to be bearish when you could see mortgage credit growth actually ultimately accelerated to, I think it was 14-year highs at one point, that this was going to fuel house price growth. But not only that, fuel inflation, because mortgage credit growth is basically it's commercial banks creating money. It's a creation of the monetary base. When people go and take out mortgages, the banks literally create credit by clicking a button. They create money into the monetary system vis-a-vis new mortgages. And so all you had to do, for example, was look at, here's the U.S. monetary base, at one point growing by more than 20% on a year-over-year basis. So the monetary base growing by double digits. We hadn't seen that in many, many, many decades. And now, in fact, rolling over. You can see the monetary base now rolling over. Again, less credit being created through new mortgages, house prices rolling over, monetary base rolling over. And that was really one of the leading indicators for inflation, right? If you're growing your monetary base by 20+%, of course you're going to have inflation. That was, again, part of our inflation goal. I don't get everything right, but I was definitely right and very early on that call for inflation and for house price bull market. And now we're seeing the opposite, and that continues to be my thesis, that I think we're going to see, I think people are going to be surprised how quickly inflation will come down. I think it's going to come down, maybe not to 2%, but I think it's certainly going to come down fairly quickly from the 8% or so that we hit. And one of those indicators that you can look at, that was again another leading indicator going through this, was used car prices. Everybody knows the phenomenon that everyone started, going out and buying cars during the pandemic. There then were shortages for these vehicles, and the resale market took off, and Carvana exploded. And of course, now all you have to do is look at the stock of Carvana, down like 95% since its peak earlier this year. Used car prices are now down 14% year over year. Again, guys, look at this historical chart on used car prices and tell me this was one of the leading indicators for inflation. And it's certainly telling you that, okay, if you've got house prices falling over, you've got used car prices falling over, you've got goods prices rolling over because there's an excess of goods. People have stopped spending money as their wealth has been evaporated, not only through the housing market, through their 60-40 portfolio, through the crypto market. So that continues to kind of be my view. The only sort of thing that I contend with and say, well, I don't know. I'm not convinced that it's going to get back down to 2%, but I think we're certainly going to see, we're going to get the recession that central banks are salivating and frothing over the mouth because that they desperately want and need. When was the last time you had a central bank that was so ecstatic to actually engineer a recession? We're going to get that recession. We're going to get inflation down. I'm skeptical that you're going to be able to get it down to 2 and hold it at 2. The reason being is I think we are in this new regime shift of governments having found the money printing presses. I'm scrolling through Twitter, and there's 2 tweets that I see on the same day. Well, one's from our federal government, Justin Trudeau, tweeting out that we're providing parents up to $1,300 per child under $12, and $500 top-ups to 2 million renters. And then I'm scrolling through, and later in the day, I get another tweet from the new provincial government, the new leader of the NDP here in BC, David Eby, and I like David Eby. I've chatted with him several times. I would consider him a friend, but I look at what he's coming out and saying, that his first move as the new premier of BC is to give $100 credit to everybody. Everybody in BC is going to get $100 check in the mail. For what? It's calling it. It's the cost of living credit. So I do worry that you've got Tiff Macklem at one hand of the Bank of Canada, raising rates, unprecedented moves. We're up 375 basis points year to date. This guy's aggressively trying to bring inflation down, and you've got two levels of government that are actively doing the opposite and mailing people checks. This is the issue that I have. So it's kind of like you're looking at the data and saying, okay, well, everything's rolling over. I think you have a strong case to say you've got some deflationary forces in effect that are now competing against the printing press of the government. Because the government, so two people can create credit, commercial banks through new loans, and the public sector through basically spending and issuance of new debt. Those are the two people that can actually create broad money supply. And so that's kind of you're looking at is the commercial banks are sort of slowing down their credit creation, but you've got the governments, on the other hand, creating still inflation. So it'll be interesting to see. As I said, we're continuing to watch a lot of the same dynamics. We can see is the housing market data continues to turn sour. We're seeing layoffs in the mortgage sector, the construction sector, etc. Again, all deflationary. That's why we've seen rents topping out in many major metros. Looks like other than Ottawa, which again is the benefit of the public sector, which clearly is still enjoying full employment there. But we are starting to see rent growth peaking out in major metro markets as the labor market, I think, ultimately tops out. And this really goes hand in hand with what the U.S. largest REITs in the U.S. have been saying for several months now, which is they're seeing their rent growth peak and in some cases actually rolling over. So we'll see. Hope that helped. See you next week.